I recently came across an article in one of the leading financial websites in India, which talked about how the people who have retired are getting very poor returns, and it suggested what they should do. Let's take a look. Welcome back to Be Rich. The article suggested because returns from debt mutual funds and fixed deposits are very low, and anyway, TDS is there on both mutual funds and on fixed deposits. The returns are very poor, and at this point of time, they are trailing inflation by a big number. These retirees must get rid of some of their portion of their debt funds and add stocks into their portfolio, or they should add equity mutual funds to their portfolio. Both of these advice, in my opinion, is ludicrous. Why do I say this? One, markets are very buoyant and have bounced back from March because of liquidity reasons alone. As I've never said, tired of saying, and I'm saying it here again, the Americans have printed more currency, that is, more dollars, in the last 2 months than what they did in 200 years. This money, through banks, through ETFs, is leaking into all markets, including India. This is keeping a select amount of stocks buoyant in India. This liquidity rally will reverse. The question is not whether it will reverse, but when it will reverse. We know for sure that the reversal is coming, and only we do not know when it will come. If the seniors decide to go and add equity at these high valuations, when the reversal comes, they will hurt badly. And since they are not in a position to work and earn, their nest egg can be completely eroded and they will have to depend on others to survive. Why do I say this? Because earnings are dropping all the time. It's not that earnings are remaining stagnant or moving up slightly and markets are rising. Two things are happening, which is increasing the valuation gap. One, the markets are moving upward to the stratosphere and earnings are dropping and going below the earth surface and going underground. The gap between reality in real economy and what the stocks are doing are completely different, and the gap cannot be bridged. Let me give you an example. As of today, the earnings are 359, last seen in 2013. We can safely expect earnings to drop to 320 to 330. Dropping is easy, going up is more difficult, and it is going to take 3 years for the market to go to 400. The best case for these retirees, if they invest at these levels, is the markets keep oscillating at these levels. But God forbid, some central banker does something somewhere in the world, then it begins to reverse. Nearly 50% of the money they have invested in the index can get wiped out. The retirees cannot afford to take such risk. It's better not to move into equities at this stage. Thank you for watching Be Rich. If you like the video, please hit the like button, turn on the subscription button on my channel, and press the bell notification. If you use Kindle, buy the Kindle link, use the Kindle link to buy my books. If you want the hard copy, please send a message to the WhatsApp number and my team would get in touch with you. At the very end, if you want to be in touch with me, please send a mail to berichenglish@gmail.com. Once again, I thank you for supporting Berich.